My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the air is Andrew Moss. All right, we've got a lot of things to talk about as far as markets go. But Andrew, introduce yourself to the audience. Who are you? Which background did you get involved in investing and trading? What are you doing currently?
Sure. Thanks, Michael. Thanks for having me on. It's a pleasure to be here. I am a professional trader with T3 Trading Group, doing work also with T3 Live, and some of you probably familiar with that group of companies there. I've been doing that for several years now. Before that, I managed portfolios for clients at Morgan Stanley. I was an advisor, PM, financial planner, all that kind of stuff. So kind of been on both sides of the fence with that. And the markets have always been an interest for me for, pretty much my whole life. So like you, Michael, my dad was in the business. He started me reading point and figure chart books and Chartcraft, when I was an early teenager, and just kind of never left it. So here we are.
So what's some of the differences when it comes to managing other people's money versus managing your own, just from your days as a PM?
There's a great simplicity in managing your own money. The thing that was much more involved, and a question I got after I made the switch a lot is like, oh my God, isn't that so stressful? And for me, actually, it was kind of less stressful, or stressful in a different way. When you're working with, a large number of clients and you've got their life savings and you know everything about them, there's so many details to keep straight, and it's the kind of things that stick with you, and you really worry about people and you want to make sure you're doing the right thing for them and all that kind of stuff. And here, I get mad at myself if I mess something up, but it's just me. I can deal with me, it's for most of the time anyway. So it's a different, just a different attitude, different mindset. It's got its own complications, of course, but for me anyway, they suit me better.
Yeah. And you're not going to sue yourself for a big loss, right?
That's right. I haven't done that yet. So, it's probably not going to happen.
Really what I'm trying to hit on there is that, when you're fiduciary managing other people's money, you got to follow certain guidelines, right? You're doing SMAs, you got to have an investment policy statement, make sure that, the portfolio is being run to that. There's to your point, a simplicity in dealing with your own portfolio, but that makes it very different than being in the industry. So are there parts of being in the business side of investing that you miss at all?
It's a great point. And that's just what I was running through my head is, there's a lot of positives to that. It's very rewarding when you help people reach their goals and get to do the things they want to do, maintain the type of lifestyle that they were shooting for, all that kind of stuff. And the rewards always were much, much greater than the stress and the risks that come along with it. Trading on your own, I say I'm not on my own. I work with a fantastic team and a fantastic company. But, when you're just trading your own money, that's very satisfying too and very rewarding. But you think about, okay, what can I do to help other people? What's the bigger point here? What's the bigger picture? And so something I put on that I remind myself and I put on Twitter and try to share is my only objective here is to become a better trader and to try to help others do the same. So I write a couple articles a week. I'm active in a virtual trading floor with our group at T3 Live. It's, just trying to get better every day and see if I can't do something to help others do the same.
Let's focus on that word better, right? Sort of the idea of becoming a better trader. I always go back to this point that, in every domain in life, there's an element of skill and there's an element of luck. But some domains have more luck than skill in terms of what actually happens, right? A surgeon is not a good surgeon because they're lucky with the way they are doing what they're doing, right? But a trader could be lucky because of a particular lucky moment or trade. How do you think through the question of becoming better in the context of even knowing what's skill versus luck?
That's a great question. And, there's all kinds of sayings and platitudes about lucky versus good and all that kind of stuff. And if you do the preparation, if you do the work behind the scenes, you get ready in advance, you find yourself lucky occasionally, where if you don't do any of that stuff, you're never going to get lucky, right? You might, but it's all about stacking the odds in your favor. And so better planning, better analysis, better mental and emotional awareness and behavior, all of those kind of things are going to stack in your favor. And that's just that there's always more to work on. We're never going to be the best ever. We're not even the best version of ourselves. It's cliche as that sounds. It's just really a constant journey of improvement. There's always, I made a mistake. I missed a huge trade in AMD this morning. I had other things on my list and I wrote in my notes, for instance, on look at AMD as a catch up. Semis are catching up. The market's popping and AMD went up, 10 points or something. I just watched it from the sideline. So there's a very easy thing. I got to focus better on the ideas that I write down in the morning. And that stuff never goes away because you never catch all the trades and you never or almost never execute each trade to absolute perfection. It happens, but there's hindsight is a wonderful curse, and you're always looking at things and saying, man, why didn't I do this? Why didn't I, execute a little faster or take a little more size or whatever it is? Those things are always going to be there.
And actually, I'm glad you mentioned the point about sort of better planning. Planning has a time frame element to it to some extent, right? You're planning for something that could happen short term, intermediate term, or long term. So talk us through your framework as far as how you try to look at markets in terms of, different time frames, and then planning for something in the future, which can be very different than a short term position.
Well, that's another difference in where I was versus what I'm doing now. That, working for clients and long-term savings and that kind of stuff. Everything, of course, is a very long-term lens. You're looking at very big picture, bigger overall trends and that kind of stuff. And now I focus more on swing trading. I'm looking from a couple of days to a couple of weeks. And you just have to make sure that you're formulating your plans on the time frame that you're actually operating in. And it's easy to look at the market right now. It seems strong. It's going up. There's lots of good things happening despite lots of negative headlines. So, but you got to look at that and say, okay, what does that mean? Am I buying a position now for the end of the year? Or am I buying a position now for the next 2 days or 2 hours or what? So, different plans on different time frames, and then trying to make sure those time frames are aligned and in unison is a very important part of the process for me, and probably for most people if we're doing it right.
All right, so let's talk about how you go about analyzing and determining what to trade in, at least from a short-term perspective. What are some of the things that you focus on?
So day trading and swing trading, depending on the environment, is where I operate mostly. And so it's really kind of what's the headline, what's the news, what's hot today, what is, where is the opportunity? Kind of hate to use the headlines and say what's hot, but let's not kid ourselves. That's part of it when you're focused on the short time frame. So, trying to see where, I've got a watch list, as probably everybody does. You got your active positions and going through and say, okay, is there any headline risk or opportunity? Who got an upgrade? Who got a downgrade? What's out there that might make this stock move today? And so is perfect example again of, and picking on myself here a little bit because it's the trades that I missed, was that you're looking at NVIDIA, looking at Marvell, looking at some of the semis that are, doing really well. And here's AMD just kind of beat up lately relative to those others. And looking at that and say, hey, all of these other trades are going. Why is AMD left behind? And don't know the reason, but you can look at the price action very clearly and see after a short dip, the buyers came in. And so somebody was obviously thinking the same thing. And that's where, it's the trends show up on a 5-minute chart, on a daily chart, on a weekly chart, all that kind of stuff. And so today, that was a trend, and there it went. So it's just, I don't know that there was a headline or any particular catalyst, but you're just trying to put that puzzle together every day and see where does the opportunity lie.
Yeah. And I think it's important that traders be honest with themselves as far as that time frame and their justification, right? So to your point, when you're short term, you do want to play what's hot, right? So if you're a long only trader, you know what? Unequivocally, NVIDIA has been the place to be. But from a longer term perspective, it's a different animal given valuations and other dynamics. I'd argue, which is why I keep on saying NVIDIA's fucked. It's just a question of the time frame, right? But I do think that's also what's missed by people is the reasoning for a trade. Get it. Technicians always just look purely at price behavior, but there's more than just price that causes somebody to buy or sell.
Well, there certainly is. And, who knows what the reasons are? We never probably know them all. And a lot of times, at least some of maybe on any time frame, maybe it doesn't really matter that much. The only thing that matters is that we have an idea of where we think the price could go and maybe a little bit of the why, and that we formulate that into a plan. And so, and I have to chuckle NVIDIA that was a great trade for me this week. 2 days ago, it broke out. It's got a nice 3-day move, and now I'm flat. Who knows what happens next? So that was a great opportunity. And for me, I thought NVIDIA was fantastic. For you and usually your comments, if I'm reading correctly, is do you want to go up and load the boat on NVIDIA for your long-term savings or retirement or whatever? Hell no, you clearly don't because of valuations and other reasons. And so time frame is everything. And I love the point that you make repeatedly. Is like, guess what? You can be bullish and bearish at the same time. So I think the market's very strong. And that's not a matter of thought. It is very strong.
No, that's fact, man. It's like, it's funny because I get a lot of people that are just selectively choosing things, not my overall view. Like, I was one of the loudest guys saying this is going to be a melt-up year From April to May, I said that there was likely a correction, which didn't happen in the headline averages, but 7 sectors out of 10 were down and down heavily. And yeah, my own signals look June, but I've been more negative because I see the sentiment is so one-sided. But that's what happens, right? Like you and I both know overbought can stay overbought for a while, but you can still be bearish, just being ready for when that resolves itself to the downside.
Sure. And NVIDIA's got a very bullish move for the last 3 days, as we just talked about. Does that mean I'm very bullish for the next 3 days? Probably not. It's getting a little extended and maybe it pulls back. Who knows? But it's not as attractive now as it was earlier in the week, right? So short time frame, medium time frame, long time frame, you have to put all the pieces together.
I've seen a lot of people come at me and say, when you're in these kind of environments, you trade the chart that's in front of you and you just move your stop losses up. It's like, the best money's made in bubbles and you just keep on moving up your stop loss. And I always come back and say, well, it's that easy, right? Just put a stop loss when you're in a bubble and you're going to be fine. Talk about risk management when you're in these kind of mania type phases. Like I think we are in some selected stocks, because from everything I've looked at, all the back tests, all the studies I've seen, you put a trailing stop loss for something that's going vertical, at some point it gets hit, but then there's a temptation to go back in again and chase. And it's not the stop loss, it's the desire to get back in after the stop loss gets hit that causes the problem.
It's right. And it sounds easy, but it's not easy. It's incredibly simple. It's not a complicated thing, but it's not easy to do. And that tendency to go back, like right now, as we said, the market is incredibly strong. It's improving on all kinds of metrics, at least for, year to date and medium term. But every sale has felt early, right? Like every time you sell something, it keeps going up and you're like, damn it, why did I sell? Why didn't I hold more? So swinging positions and trailing your stops up is absolutely been the right thing to do in the right stocks that are trending, but it doesn't make it easy because of, again, to go back to the example, how do you look at it? You can look at NVIDIA right now and it's off the highs of the day and say, I feel very confident that this is going to move closer to its 8-day moving average over the next week or so. So what do? Do you sell? Do you short? Do you keep holding and trail your stop up? That, all of that individual decision has to be done on a one-on-one basis. So you just have to figure out what works for you, and whether that's holding some and trailing stops. David Prince, one of my colleagues, says it very well. He sells some and hope I'm wrong. That's, as you're going, scaling in and out of positions, taking some profit, trailing your stops up, and then just see what happens. And that's, that's something that I'm trying to work on. Again, when you're in a market environment where every sale feels like it's been too early or wrong, it's, it makes sense to try to work on holding longer and trailing those stops up along the way. And, your risk is managed and you don't have to short every pop. You just kind of do what works and is consistent for you and take it from there.
Yeah. And I've always been loud about the point of, I don't believe in, this is me personally, I don't believe in shorting. I don't believe in puts or directional bet, because oftentimes, you're wrong. The biases markets tend to go higher just in terms of up days versus down days. So better to do a rotation. Now, I noticed in your Substack, you mentioned financials breaking out, energy, and I actually just put a piece out on Seeking Alpha, making the observation that if you look at financials divided by tech, XLF divided by XLK, right? You pretty much add the lows from 2020. And I suspect, and I want to hear your thoughts on this, that we could be on the verge of a big rotation independent of direction out of technology, where you could see some leadership in what you exactly noted, financials and energy, which is really value versus growth. So lay out some of the things that you're seeing on that end, because I think that's one of those dynamics which could be a big one. I mean, you had value really working up until the regional bank crisis killed it, but now you might be seeing another turn here.
Well, we're already seeing it very strongly in the small caps, and that's so, which is no surprise. You look at what a couple of years ago, the small caps were trying to play catch up because there was a lot of smaller energy names in there. Now there's a lot of AI names in there. There were a lot of regional banks in there that got beat up earlier in the year. And that's exactly the kind of rotation that what you're referring to now is. That's the kind of thing that'll keep this bull market going. Is it doesn't have to be a huge sell-off in other areas, but when the laggards start getting bought up as well, like we're seeing with IWM, like we're seeing with XLE and XLF, for example, even though XLE is down today, it's not out of the woods yet, but it's trying, So those are some of the things that I'm watching for, just for added confirmation, added strength, more fuel for the bull market to go higher. I haven't looked at tech versus financials specifically. I do like to look at relative strength charts. And I know, I think you put one up the other day about, or maybe earlier today, about staples versus consumer discretionary, which is always a good indicator. So those kind of things, that rotation, those laggards getting bought up, I think is a very important part of the process.
So what do you do when you're in these periods where, to using your words, right, like it looks like it's trying, right? Even the small to large cap ratio. Okay, yeah, I mean, the argument is that, now the momentum is broadening out, but the small to large ratio, if you just look at that, it's basically gone nowhere since like early May, right? You're back, you're still hovering around the kind of 2020 relative level. So there's a lot of whipsaws. If you're trying to play small caps, yes, the beta is there, so it's helping, but on a relative basis, you're not getting anywhere. So when you're in those inevitable periods of whipsaw, what do you do from a trader discretionary perspective? Do you step away? Do you look at other plays? Do you keep getting whipsawed until it stops? What's your own way of looking at things?
No, because for me, I'm not trading those relationships specifically. It's a part of the puzzle. It's something I want to be aware of. And that's something that I'm still working, every Saturday morning, I'll do it again tomorrow. I'll put up the weekly chart and then the monthlies at the end of the month. And I want to know what the bigger macro picture is. Does it directly affect my day-to-day operations? Probably not so much. I do think it's important to have that big picture view because, again, we want to be swimming with the current, not against it. But, to look at the ratio of small caps versus large caps, it's interesting, but I'm not taking trade based on that. I'm looking at, obviously technology has been stronger than banks. So guess what I've been trading more often? Things in the technology sector. That's the kind of relative strength that actually plays into my trading directly and into my, kind of my day-to-day operation.
So how do you know when to switch from that? Because, there's a lot of interesting studies that show that, momentum is obviously a very real phenomenon and
absolutely
right. But there's also, well documented what they call momentum crashes. There's something, the factor itself, right, goes from kind of like multi-standard sudden drop, which is why you see some of these momentum focus ETFs with that tilts at very large relative drawdown. So how do you know, and I know it's hard to do, right? But is there anything that you look to say, you know what, this momentum's strong, but it's too strong and now it's vulnerable to a shock reversal?
Well, the switch is almost always a gradual process. It's not, you never see it in real time. Like, oh, that was the day. Today's the day. You look at it a week or a month or however long later, you're like, that was the day. Like October. October was the low, right? Well, we didn't know that at the end of October. Some people said it. So a lot of people made some really good calls about breadth thrust and that kind of thing, but we didn't know for sure. So the point is, it just goes in a gradual progression, and you start realizing, like, hey, wait a minute. All of a sudden, for example, not saying that's happening, but like a possibility from here might be like, hey, all of a sudden my long technology trades aren't working as well as my long financial trades or whatever. And so you start noticing things like that along the way. And then as you're going through your daily watch list, looking at streams and that kind of stuff, you might say, hey, I'll see a lot more setups. Well, here's an example, for over the last few weeks. A lot of the better, more attractive setups for me have been in the small caps. It's been the Bitcoin related names, Mara, Riot. It's been some AI names. It's been some smaller semiconductor, that kind of stuff. And so you realize that, hey, the small caps seem to be playing some catch up here. Well, guess what? I look at the chart of IWM. It's going nuts. Everything's in alignment. Those kind of things happen. So it's just, again, it's something to be mindful of, but it's kind of a barbell approach there of a top-down macro and a bottom-up individual stock selection kind of approach.
How do you think about volatility beyond just VIX levels, right? So you have a lot of people on FinTwit that will say, oh, the VIX is so low, and that means tomorrow it's got to come back in and rise. And you and I both know that's not necessarily the case, but does volatility factor in at all to, your short-term or intermediate-term type swing trading?
Well, it's a good question. Because are we talking about volatility in terms of the VIX index, or are we talking about volatility in terms of day-to-day P&L or variance from expectation? Or, there's a lot of different ways to define volatility. So if I go to kind of the textbook definition or the most commonly cited factor of the VIX index, again, it's a layer. It's something I post. Actually, I haven't included a VIX chart in my weekly articles for quite some time because all this debate about zero DTE and is the VIX even useful anymore and all that kind of stuff. And, I don't know. I think while VIX is low, it's generally better for stocks. And sometimes that's doesn't seem to make sense or the relationship changes. One of the things that I really like that was for me, a very useful definition of volatility was, or still is, Van Tharp's market type classification. And he goes from strong bear to quiet bear to neutral to quiet bull to strong bull. And he uses his calculation of SQN, system quality number, which I won't bother the explanation of, but it's just a way of ranking the outcomes. In this case, I think it tracked weekly, monthly, and year-to-date performance of different sectors and then combine all that stuff into a market and a system quality number score for the whole market. And that, when it's a bull quiet or a strong bear, that's important. Now, I think that's for a trader, that's been one of the most practical, not definitions, but measures of volatility, I think. And so if you translate that into something that more people are familiar with, VIX is 30 and the S&P is jumping by 2% several times a week or that kind of stuff, you better be ready to, get knocked around a little bit. And when it's smoothly going up and VIX is below 20, it's a different environment. So again, long-winded answer there. I apologize. That's kind of how I think about it and how it factors into my process.
During different periods of volatility, do you switch up where you focus your attention? So, like last year, what benefited from volatility was the dollar, right? Usually it's treasuries. Obviously, it was not the case last year, which I've said many times was my hell. But I want to get your thoughts on transitioning to the dollar because it looks like to me like you believe the dollar's going to go lower, which should be consistent with, the idea of a rising market to some extent. What makes you think the dollar's going to maybe keep going in that downward trajectory, at least for now?
Well, it has been going lower. It's, if you look at the weekly chart so far, it's a huge red candle, biggest one we've seen since November of 22. And so the dollar is going lower. The question, of course, is how much lower does it go? I don't know, but I think, one of the charts that I do include in my weekly chart roundup is BXY. And if you take the move from the lows of late 2021 to the highs of September of 22, and just look at Fibonacci retracements there, they've been useful. For me, there's been action around those levels. And the next one below is the 0.382 level or the 61.8% retracement of this overall move, which is at about, just under 99 on the DXY index. That's a reasonable spot to target, I think. I'm not trading the dollar. I'm not targeting it from a trading standpoint, but I think if the dollar's going to keep going down, that there's also a bit of a pivot level there. And that's probably a reasonable place for it to stand. Brian Shannon recently put up a great chart with an anchored VWAP showing a similar level. I won't say it was exactly the same, but I think it was pretty close. Like, look, if the dollar's going to find a place to bounce, this is probably a decent spot to keep an eye on. So, I think if it gets to that level and then kind of chops around sideways, that's just another log on the fire for stocks to keep going up, I think.
Yeah, I do agree. I think actually the dollar's move is going to be quite a tell in, I think it was late or mid-May. I put that tweet out that got a lot of traction. I said, the dollar's about to make the greatest comeback since Lazarus. Actually, no, it was actually in I think mid-March. It's one of the regional bank dynamic. Right. And I was saying that just because, it looked like the dollar would rise. And, had to get a decent move and then obviously going all back, especially this week. But I do agree. It seems like the dollar is going to be an important tell here. I myself, short-term, actually think it's probably more likely to have a bounce and be a bull move on a upcoming risk-off trade. But I do myself believe that the longer-term secular trend for the dollar is going to be lower. It's interesting, right? When QE3 took place, everyone said in 2012 that zero trade policy, all this added stimulus was going to crush the dollar. And that ended up being the low for the dollar. And you ended up having a huge rally, right, since then. Yeah. So I made this case before. It's like now in the absence of going back to that kind of an era, then the opposite should hold true, which seems counterintuitive. A tightening environment, higher for longer would actually be bearish for the dollar, but maybe that's the case.
It could be. And when there's so many factors that have to be included in the supply-demand relationship of the dollar, I certainly don't think I can keep them all straight. But I'll try to be dumb and look at the chart and let the chart show me what's going on. And, that move again from late 21 to September of 22, I mean, it was a parabolic move. And to see that when it finally did fail, it came down, somewhat predictably. And to see a parabolic move like that get back roughly 2/3 it seems pretty normal, I think, right? I don't have stats on that, but I think I remember that's a pretty common occurrence. So, crashing further from here, who knows? Staying low and chopping around like it's been doing all year so far, I think to me, that seems like a likely scenario. And how that relates to bonds and treasuries is very interesting. I actually, one of the things I was pointing out earlier in the week was the nasty breakdown in TLT. I call it a nasty breakdown. It went below a lot. Maybe it's not that nasty. It was just a big red candle, and it did not look bullish for bonds. And then this week, we've got a big green candle reversal coming back up, and
whipping around, right?
Yeah.
It's funny. I was looking at it just now as you're talking.
Yeah, lots of whipping back and forth there. So is this, you're talking a lot about the possibility of this huge credit event, which is, again, on a big term macro basis, it's hard to, I certainly see the case for that. But what's your take on the treasuries and what does this do, if anything, to the likelihood of this credit event, or what kind of credit event are you looking for? What does this change your thoughts on that any?
The dollar and treasuries are, as you know, connected, especially during those flight to safety type of dynamics. So you've got this interesting interplay, right? Let's say the dollar were to keep going lower. That's going to be inflationary.
Mm-hmm.
So that should put pressure higher on yields, which means TLT will go lower in price. It's hard to know, right? Like the flight to safety dynamic in treasuries came back for a fleeting moment in time in mid-March as the regional bank dynamic was taking place, when I thought we were going to be in a corrective environment. The point is that it's hard to, I think it's interesting that treasuries are chopping around, and it's chopping around, by the way, as if the next speculative short positioning is only going higher meaning betting on long duration yields rising as CFTC, large spec positioning, gets more and more aggressive. There was a tweet I saw that Raoul Paul put out, and Jason Shapiro of Crowded Market Report, who I've had on before, has been noting that there's some unbelievable short positions going on in long duration treasuries. Now, I've used that line before, that I think myself that there's the mother of all short squeezes will happen in treasuries, not bonds, right? Because under a credit event, right, bonds, which, when I say bonds, talk about corporate credit risk, those would get hit. You'd have widening of spreads, right? And treasuries would be, the beneficiary of the volatility. But yeah, if you think about it from kind of a contrarian fat pitch, type of standpoint, the amount of betting against treasuries makes me think there's going to be an enormous rally, which means collapse in long duration yields.
Yeah.
But I don't know when, right? And nobody does, right? And to your point, it's just chopping around till then.
Well, if, from so far for the year, it's been a chart that, much like the stock market was, in the early part of the year, it's like this thing, everything says it should be going lower. The charts look terrible. The news is terrible, but it just wouldn't go down. And, that's another thing you shared the other day, which I started writing about in March as well. It's like, all right, the market's had every reason to crash, and it doesn't. So what does that mean? It doesn't want to go down. Market wants to go up. Now it's going up. Treasuries last week looked terrible, or TLT looked terrible. It should go down further. No follow through, right? We actually have buyers this week. So again, I don't know what it all means. I just look at the charts, but it's interesting to, I do think it's important to keep track of those big picture details or possibilities. So that's why the question. So interesting stuff.
Just to reset the room for the remaining minutes here, everybody please make sure you follow Andrew Moss here on Twitter. Check out his Substack as well. This will be a podcast under Lead Lag Live. And again, if you want to come up and, talk shop, talk markets, ask questions, feel free to click that bottom left mic request button. Okay. So, and I'm curious, do you yourself, do you trade TLT at all, or is it just not as interesting from a volatility perspective for you?
I don't trade it. I have traded it, but it's rarely a focus. That there are some guys in the room that utilize it from time to time, and it can give some good moves. I mean, you look at if you just look at the daily chart and see the extension lower on Monday, probably not terribly difficult to see the potential for a bounce play there. But it's not something that I tend to focus on.
Yeah, it's funny. I think a lot of people look at it but don't trade it. I mean, I do, right, from my own strategy, but that's how they're designed. But I get it. It's not sort of as obviously as sexy as individual stock stories. And yeah, it's interesting, right? Because I think a lot of people, when they talk about treasury bonds, they're like, I don't want to trust the U.S. government with my money, right?
Yeah.
So they don't want to even think about it from a trading perspective because they have this bias against, all the leverage the system has, right? It's more of a side note.
Yeah. People come up with all kinds of stories about why they do or don't want to do stuff, right? It's, you never know what folks are thinking, but for whatever reason, but it makes me think of another question. You mentioned there, you made the distinction between the bond market, which would get scarier in a credit event, versus treasuries and government bonds, which would be the flight to safety. So one of the questions that when I'm looking at the charts of TLT, AGG, HYG, whatever bond proxy you want to look at, the old saying or the, common knowledge is the bond market is smarter than the stock market, right? And so I look at that and I say, okay, what does the bond market know that the stock market doesn't know? Is it the credit event that Michael's always talking about? Is it what's going on there? So my follow-up question to that is, does the treasury market count? In your opinion, does the treasury market count? And let's say, is the treasury market stronger or smarter than the stock market, or is it the corporate bond market that is applicable in that adage?
Yeah, no, I mean, it's nuanced, right? So I say it's both. It's credit spread,
Yep.
right? So like this has been a lot of my pushback for last year with those that say it was obvious stocks and bonds will fold together, which I never once disagreed with. What was not obvious was treasuries failing as a flight to safety asset, which is, I have this whole thesis around why I still think we're in a bear market, which sounds crazy because of the treasury to equity relationship, right? That I've noted many times having failed, but it's only failed if the drawdowns are over, which is what I think is going to be unique about this cycle. But your point is valid. There's a very tight link between the VIX, for example, and credit spreads. So when the VIX spikes, usually junk debt, corporate credit gets slammed. And then as that's happening, right, because basically volatility in equities is perceived as increased default risk in the bond market. I mean, that is the connection, right? The causation.
Yep.
So high volatility, increased default risk. I need more yield because this company might go under. So I'm going to sell off bonds because I need more income. But as that happens, money does move up the collateral scale, ultimately to treasuries, which is why the flight to safety dynamic, is called that, right? Safety because the U.S. government owns us through taxation. So, but your point is, I think, interesting, right? It's like, and I've used that line before. It's true. The bond market is seen as smarter than the stock market because the focus for bond investors is not return on capital, it's return of capital. I want that money back I lent. But by the same token, that doesn't mean the bond market is always the straight A student, right? The bond market can obviously be wrong too.
Sure.
Right. So I think to your point is part of the mosaic, of way of looking at markets. So that lends to the question of, where do you see things going? I understand time frame, short term, you're trading much, much quicker, right? But if you were to say, okay, into the end of the year, what would be your bet? Do you think that markets do what they most of the time do, which is that they, make new highs in December? Or as I've noted, and people have jokingly said to me, it happens to be the same number. Is there a chance that we could actually top out for the year before December? I put out that tweet, historically going back 1926, the broader stock market peaked for the year in July. And people noted that's 1/12 of the year, but I wasn't referencing the number of months of the year. I'm just factually 8.3% of the time stocks do in July, right? So do you think are we more likely to have momentum in the large cap averages or rather rotation where there's still potential to generate returns, but you've got to switch out of the things which work?
I think both. And let me elaborate, of course, because the point is, I think the market's going to keep going up through through the end of the year. And the reason why is because of the rotation, because the lagging areas are catching up. We're seeing buying in those areas. Which tells me people want to own more stocks, and they can't. Nobody's rushing out to buy. Well, obviously there's buyers today, but maybe not as many people are rushing out to buy the Qs or Nvidia or that kind of stuff today after 3 strong days up, or at the year highs and all that kind of stuff. But people are buying other things. They want to build out their portfolio. This rotation is spreading around, and more people are buying more stocks. More stocks are making more new 52-week highs than lows, and things are getting broader and stronger. Now, couple that with seasonality, pre-election years, all the tendencies all line up to say the market's going higher for the rest of the year. What the strong 6 months generally leads to a strong first half of the year, generally leads to a strong second half of the year. Again, momentum, trend following, all that. The tendency is definitely up, and I will continue to work in that direction until I see evidence of that change. So my opinion is that the market's going to continue higher throughout the end of the year. Now, that said, zooming in a little bit to a smaller time frame on the seasonality, that says, and look at Almanac Trader. If you haven't seen his stuff, the Stock Trader's Almanac got great stats on, why it might be likely that there's a bit of a pullback through the second half of July and into August. That those things doesn't mean it's going to happen, but that's the tendency. And so that's the roadmap that I'm following. That's what I'm looking at. I think that's the higher probability outcome. And so will operate accordingly.
And by the way, I'm with you on that.
Yes.
You need to have a credit event to break the momentum because it's not going to just turn around. You'd have to have some kind of catalyst, right? Because the pre-election year is undeniable. It's I myself, and I've had Jeffrey Hirsch on Spaces a couple of times, right? It's like, this is not open to debate. I mean, pre-election years are the strongest of the cycle. But I always go back to, that doesn't mean that you can't have big declines, and I keep on referencing 87 was a pre-election year. And I think people get confused. They think that I'm making an argument that we're going to have a 1987 type of, Black Monday. My only point in saying is that history has shown that you could still have a strong pre-election year, but a very violent one, right? So I don't know. It may not be the case, right? Maybe it is going to be just almost like 2017. The market's just going to keep on pushing higher, and who the hell cares about anything else? And it's rotational. Great. I mean, path matters more than prediction, but I don't know, man. I mean, with the kind of sentiment that I'm seeing, from the things that people say to me and other things like, greed versus fear, all this stuff, it seems like the dynamic is there for not just momentum to continue, but also for a surprise on the downside. That's all.
Well, we never know what's going to happen, right? There's always something lurking out there, whether it's a credit event or, portfolio insurance from 1987 or, whatever it is. We don't know those things until we know them, right? And that's why we have risk management and proper position sizing and know when to go on defense versus offense and all that kind of stuff. So while I think everything, that's too broad of a term, while I think stocks are going up throughout the rest of the year for the reasons we just outlined, it doesn't mean I'm not ready and looking for, always looking for the risk and how to protect if things turn around, because it can happen at any time. I mean, the banking crisis, it didn't come out of nowhere, but it's, those things always seem fast when they're happening. And, it's who knows what else. I know you posted some information about housing. It's the housing market. It's the debt market. It's 7% mortgage rate. It's all, there's all kinds of things happening, wars and so on. The risks, they never go away. All we can do is try our best to make sure we're aware of them and understand how that might affect our money and have a contingency plan in place to adapt as the situation changes.
So let's talk about that risk management point. There's a lot of ways to manage risk, right? We talk about stop loss as an example. I'd argue just being quick on the trigger can help mitigate risk, but also leave you to whipsaw, which is a different kind of risk. But how do you yourself think about managing risk depending upon where you are in a trend?
Position sizing is the most important part of trading and our best tool against or for proper risk management. So it's about knowing when to be big versus small. I like to scale in and out of things a good bit. You get in a trade, works in your favor. You take some off, you lock in some profit, and you have your stop, whether it's an actual stop loss in the system or it's an alert or it's a mental note, some kind of plan to say, where does this thesis negated and where do I cut tail and run and look for the other thing? So, if you do that on a position by position basis, you look at your positions at aggregate and see, okay, how much risk do I have in the whole portfolio? And, I don't tend to hedge a lot by taking shorts against my longs or that kind of thing. It's something that happens from time to time. But, generally speaking, it's just, for me, it's just knowing what do I own? How much of it do I own? And what's the damage if I get stopped out? And then, how does that, I got 10 positions and they all get stopped out. If there's a 1987 type crash or a flash crash or whatever happens, gets all stopped out. How bad does it hurt? And then what do I do next? So that's, kind of it in a nutshell.
Are there any interesting stocks that you're looking at now that you think are starting to get some early momentum that, you haven't quite pulled the trigger on, but, you're waiting on it?
Energy, like we talked about earlier, banks and energy are starting to pique my interest a little more. We've been looking at the catch up trades a good bit. And so those are the things that, they haven't gone yet, or at least not like the rest of the overall market. I think there's still a lot of opportunity in small caps. And so just looking at while the big names go up, well, and thinking back on that a little bit this week, actually, Amazon, Google have been the catch up trade, right? They actually took a break. The mega cap stocks they came down, put a list out earlier in the week and last week about things that had finally come down and touched their 21-day moving average, which, had for some of these names hadn't happened in a long time. For Meta, as a matter of fact, it hadn't happened all year. Even in the last year, it's been a really long stretch. So, but going back to others, Google's Google was a very nice catch-up trade. Amazon was a kind of a laggard there on a very short time frame that cooperated well. So just to kind of give an example of the scenarios that I'm looking at, take that across any names and look at any sector that's been going. Okay, so what hasn't participated? Again, rotation. If people are looking at, see what hasn't gone yet. Maybe there's a trade there, A and B, all that kind of stuff. So those are things that have happened. As far as what's coming next week, I don't know, or in the weeks beyond, but I'm like I said, I'm looking for that pullback for the next 2 to 4 weeks. Probably, I think we're going to get a better chance to buy. So as things, if I'm right, if things come back, which by the way, again, it's like every sale's been wrong. Stocks keep going further than you think they can. And so I wouldn't be at all surprised if we came back out and NVIDIA kept going straight up next week, which would really be a short-term caution signal for me, I think. But anything's going to happen. But as we do get some correction, some pullbacks, a little bit of selling kicks in, then I'll look at things that, where does the catch-up trade show itself after that? What held up better? What didn't hold up as good? Just more of the same old process of putting all the pieces together as they develop and trying to figure out where the opportunity is for the next couple days to couple weeks to couple months kind of thing.
What do you find that most people get wrong when it comes to being a short, intermediate term trader? Yeah, you've been doing this professionally and you've got the background from the advisory world. Mm-hmm. So you've seen both ends of it, right? So for those that have not had your career and exposure to that, what do you find people get wrong?
Over trading is a big thing. And that's something that I struggled with myself when I made that switch. If you make the decision to be a quote trader and you're working on a short-term time frame, the tendency is there. And I think it happens in probably just about every newer trader. It's like, all right, I got to go to work. I got to work hard. I got to do stuff. I got to earn my keep. Right. And that's where, the American culture is you don't sleep. You work 12, 14, 16 hours a day. And you're always doing something. And that translates into the market. Like, I got to take a trade. I got to do the next trade. And that is almost never the case. You got to be active when things are good, but the ability to sit back and wait, to not overtrade and not feel like you have to be in everything is a huge advantage and something that takes, I don't know, maybe some people they're just not like that naturally. It took me some time to learn. I think that's something that newer traders struggle with as a general rule. And the other thing is price targets or price objectives. You get in a trade, you can do any Google search and it's like, all right, first thing you got to do, what's your stop? You size your position and then what's your price target? Because you have to have that because you have to have your reward to risk ratio. So, if it's good, if you're not taking 3 to 1, blah, blah, blah. And there's a tendency to get fixated on that target, right? It's like, I can't sell yet. I hadn't hit my target. Well, it's not an exact business. It's not just because you say, or just because I say that here's where I think it could go. It doesn't mean, hold out and trying to get that last tick right into my target. You might miss it and the trade turn around and be a loser. Or you sell at your target. Lately, it's kind of been the case. Like if you sell everything at your target, the stock keeps going up without you and you feel like a dope. You're like, man, why the hell did I get out? It's still going up. So that's the other, learning how to scale in and out and to ease into a position when it's right, to go full size when the setup's really good. There's 2 different scenarios that we got to be familiar with, and then to take some off along the way. And you scale in, you scale out, you protect some profit, move your stops up along the way. It's, like we said in the beginning of the conversation, it's very simple, not very easy.
And for those who want to read more of your thoughts on markets and track what you do other than Twitter, where would you point them?
Trading-adventures.com. That's my personal website. I put out a free article twice a week, just a midweek market update and a weekend market update. It's very brief. Just a quick overview of what I'm seeing, what the price action's been telling us.
Yeah, good place to wrap this Twitter space up. Everybody, please make sure you follow Andrew Moss here on Twitter. And hopefully I'll see you all again on the next Twitter space. Thank you, Andrew. Appreciate it.
Michael, thanks for having me on. I'll give one more kind of plug there for my partner, David Prince. He's got a webinar coming up next Tuesday. That's going to be very informative. My link's on Twitter if anybody wants to see that. I really appreciated the conversation. It's been nice being here and look forward to doing it again sometime.